Thank you, Chairman. So we will now present the 2020 full year results for CEC. The presentation we'll be making this morning is split in three parts. I'll take the first part, which is giving highlights on the business, focusing more on the operations and some of the progress we've made on implementing our strategy. The CFO, Mr. Mutale Mukuka, will then come in and speak to the financial performance highlights, and then I'll come in at the end to just make some concluding remarks. I'll start with just a commentary on the COVID-19 response. I think, as we are all aware, this pandemic has impacted everybody, businesses, individuals, economies across the globe. So CEC was obviously not spared in this respect. And as a company, we needed to make sure that we implement all necessary measures to keep both our employees and the contractors safe and ensure that we continue to deliver service to our customers. So indeed, we needed to adopt the guidelines as provided by the health experts. So as a company, we did that. We had to modify. So we did modify the way we work. And so we adopted both remote working and because of the nature of our business, we still needed some of the people to work at the office. If you look at the control staff and a number of our field staff, we still needed to make sure that people do go out. So what that entailed basically was that we needed to sort of think through how do we continue to deliver service, and that required that we streamline and in a lot of cases reconfigure our teams into much smaller teams so that they can be in different places at different times, and we ensure that these teams never get any opportunities to interact. That way, if any of the teams was affected, we'd still have other teams continuing to work. So we equipped the teams with all the necessary tools to ensure that they continue to be safe and healthy. And that way, at the end of the day, we are quite happy that the objective of us continuing to make our network available and ensuring that service quality was continuing was met. And again, we're obviously part of the larger community. We needed to make sure that we're aware of what's happening in the environment and came in to provide support where required. So we did support government in a number of respects. We did support the local community, some of the charities around us, the public health institutions, the schools, in as far as the challenges of managing COVID-19 is concerned. Overall, we believe that we delivered a strong operational performance and continue to meet the needs of our customers. From a perspective of safety and system reliability, and again, this is something that we pride ourselves in, year on year, we need as a company to make sure that we continue to ensure that our employees, the contractors, the customers can feel safe working on our system. And more importantly, we need to make sure that we keep our system reliable, our services reliable, and indeed secure on a continuous basis. Some of the achievements for the year, we managed to extend the number of man-hours without a system-based lost time accident to over 8 million man-hours. Again, that's no mean achievement. Overall, we extended the number of years without a system fatality to 12 years. Again, we're quite proud of that record. And it's obviously important that we continue to maintain this record going forward. Again, overall, our system response, rather our response as a company, our response times to system faults was pretty good within sort of world-class standards, and we continue to satisfy our customers' expectations. Just a few highlights on the sort of business environment that we faced. On the power situation, those who have kept close to the Zambian situation, the supply gap obviously peaked during the course of 2020 at about 850 megawatts. And fortunately, there was a sort of categorization and segregation in the way we treated customers. So in as far as non-customers are concerned, the country had to adopt load shedding as a way of managing the supply gap. The mining customers, fortunately, were given their full power requirements. Again, this was important to try and mitigate the wider economic impact this would have had on the economy if we didn't ensure that the mines got all their power requirements. The good news, though, is that the situation has significantly improved, particularly coming into 2021. We had very good precipitation for the 2020-2021, but also the national utility, I think ZESCO, has done well in commissioning some of the new power plants. So that has significantly improved the situation, and we've seen that load shedding has almost reduced to zero. The other important issue to touch on is the contractual matters. As you recall, the bulk supply agreement, that was the basis upon which a number of services were exchanged between CEC and ZESCO, came to an end at the end of March 2020. This agreement had underpinned power supply between CEC and ZESCO. It underpinned what we call domestic wheeling, which is the provision of transmission services by CEC to ZESCO locally, and then international wheeling, again, which is the service provided for moving power through each other's network between CEC and ZESCO. So all these services at the moment are not backed by a commercial agreement. The parties have been trying to come to an agreement since the BSA ended. I have to report that up to this stage, no agreement has been reached yet, particularly on the commercial issues. So this matter is still outstanding. There are obviously a number of issues that need to be resolved by the parties. One of the issues is that a number of the terms that are being discussed may require to be guided by the cost of service, and that cost of service has not been completed yet. We remain hopeful that that will be completed before year end, and then obviously that will come in handy in helping resolution of some of the issues that the parties are discussing. The other issue is with respect to KCM. KCM used to have a power supply agreement with CEC. The company used to be supplied power by CEC. The power supply agreement between CEC and KCM came to an end at the end of May 2020. At that point, following a number of issues, the big one, of course, being that KCM owes CEC a lot of money. KCM chose not to renew that agreement with CEC, but opted to sign a term sheet, as we understand it, with ZESCO. Following that change, the contractual arrangements, obviously they needed to be restructured, given that KCM continues to be connected to the CEC network. A structure involving two agreements was foreseen, an agreement with respect to transmission services with ZESCO, and then another agreement called the Network Access Agreement between CEC and KCM. Those agreements, again, are not yet concluded, basically because of the same issues that I alluded to with respect to the bulk supply agreement as well. These matters are obviously a priority to the business, and CEC will continue to focus on this and remain hopeful that we can resolve all these matters before the end of 2021. I want to touch on briefly on the commodity prices. We are all aware that the commodity prices are quite bullish at the moment, mostly being driven by the Chinese, whose demand continues to be high for this red metal. So on the supply side, we know that there's a bit of a gap there. So that obviously is supporting the strengthening of the commodity prices, particularly with respect to the red metal. And the drive for a much greener economy across the globe is one of those drivers for the favorable commodity prices that we're seeing at the moment. The other issue, particularly important to our business environment, is obviously the default by the Zambian government that's continuing. So far, we're aware that the government has missed 3 repayments on the Eurobonds. However, what's more important is to note that the discussions between IMF and government have been reported to be going on very well. So we all remain hopeful that something progressive will be coming out of those discussions. Some announcements are anticipated in the course of May. So we are all hopeful that there will be good news coming out of there. And obviously that will be quite key in supporting Zambia in restructuring its debt and addressing some of the macro issues that continue to impact the economy. In terms of the sales, I'll touch briefly on two key business segments. Obviously, there are other two business segments that I won't touch on, so I'll speak to the supply segment. The supply segment continues to look good. In 2020, we saw the recovery of demand with respect particularly to the mines, but also in terms of our domestic wheeling. Demand has started to pick up. This is driven by a number of factors. One, I talked to the favorable prices of copper on the global market. Two, we have more power being available in the country. So we anticipate that coming into 2021, demand recovery by our mining customers should continue. There are obviously a few downside risks, particularly with respect to the mines. The big one being the non-deductibility of mineral royalty tax. The mines continue to talk about this. Yesterday, an Indaba, a mining Indaba opened in Lusaka, and we are aware this is one of the key issues that's being discussed there. So we hope between the mines and the government, this is an issue that could be resolved quickly. And if that is done, then we anticipate that most of the mines will continue to pour investments in the sector. On the power trading side, in 2020, we saw an improvement in trading margins driven by the optimization of our sourcing contracts. On a sort of year-on-year basis, our sales, again, were somewhat flat, just increasing by just over 1% during the year. We remain hopeful with some of the new agreements that are being signed that the demand will continue to grow in 2021. The key downside risk to this segment is obviously some of the transmission issues that we continue to work on within the Zambian network. Briefly on our capital program, on our 10-year capital program, we continue to make good progress there. This program was obviously impacted by the COVID-19 pandemic that we continue to experience. However, we did implement a reasonable proportion of this program. Just over 50% of this was implemented last year. This program is important with respect to modernization and digitalization of our network equipment and indeed the processes in the company. This is important in driving efficiencies, reducing costs, and improving the quality of service that we provide to our customers. Just a touch briefly on some of the projects that we're doing. So the Get Fit Solar is an important project. It obviously fits within our wider plan to invest in distributed renewable generation. This is important in as far as enhancing our supply portfolio is concerned. At the moment, this program is on hold. However, we've got a number of other projects that we are implementing within CEC. So the key challenge with respect to Get Fit is really the offtake issues that relate to the nominated offtaker with respect to this project. And those issues have to do with the bankability of the project. So obviously the offtaker needs to be creditworthy to be able to support bankability of the project. One of the sort of medium-sized projects with respect to a new customer that we're implementing in the Ndola area is the Mwekela Copper project. This project was somewhat impacted by COVID-19. A number of tasks there could not be progressed. However, we remain committed to making good progress on this project. The teams, both from CEC and the customer side, are working on measures to speed up the project. We are hopeful that we could complete this project before the end of this year. Let me now comment on the Common Carrier Declaration that was issued in 2020. As we remember, in May 2020, the Minister of Energy through issuance of SI 57, declared all of CEC's transmission lines as common carrier, and this followed the signing of that term sheet between ZESCO and KCM. What was even worse was that this declaration of common carrier was followed by a setting of an interim, or the so-called interim tariff, by the regulator, and in CEC's view, this interim tariff was assessed to be 30% of our standard tariff. So obviously that was a big issue. From a company perspective, we saw that as infringing on our property and commercial rights. We did engage government in trying to resolve this matter. Unfortunately, that did not yield much progress. In the end, following advice from our legal experts, we sought judicial review. I have to report that as a company, we are very pleased that on 26 February, the High Court delivered a ruling in favor of CEC, quashing both the decision of the minister and the regulator. We are aware that the government did not like this, obviously. They did appeal the decision of the High Court, and at the same time, they sought to stay this decision of the High Court. I have to report here that the stay that the government was seeking failed, fortunately for the business. In as far as the appeal is concerned, these are matters that we expect will be coming up in the next few months. So as a company, we remain committed to resolve this issue. We think the best position for the parties is to use this opportunity to try and finalize the contracts and focus on stabilizing the power sector. So we'll continue to seek those opportunities to engage. Thank you. At this stage, let me pass on the presentation to our Chief Financial Officer, Mr. Mutale Mukuka, who will speak to the financial performance of the business.
Good morning, shareholders, and thank you, Chairman and MD. I'll speak to the financial highlights for the financial year 2020. If you recall, in September, I think on 30th September, when we had our last AGM, we did highlight those three things as our key focus areas for the year 2020. The 2019 financial statements had high levels of impairments triggered by the payment default by KCM. State that the payment default position continued. Suffice to say that the situation was partially mitigated by the load shift or the change in contractual arrangements between the parties, which Mr. Silavwe has already alluded to. He has also already alluded to the fact that we are yet to conclude on putting in place the two agreements that are listed there. So if we look at the 2020 financial results, those, I must say, are the key issues that sort of impacted on the results in general. The lack of agreements in themselves, I guess this meant that there was a lot more uncertainty in the environment. It also triggered quite a number of legal disputes. Management's and the board's time was spent on trying to mitigate that risk. The second aspect is the fact that the first half of the year, we had high levels of impairment arising from the KCM payment default. With the restructured position in load shift, you'll see that the quantum of the level of impairments significantly reduces. So that in itself helped to improve, number one, reduced impairments, two, improved cash position for the business. Because of that, this then leads us to talk about the more detailed drivers for the financial results. The first aspect, of course, was the COVID, which has been explained in some level of detail. The KCM payment default, which increased the level of impairment from 55 the previous year to 95 million in 2020. The lack of agreements meant that we're going to spend a lot more time, attention, and increase in legal costs to try and mitigate the risk. The last aspect is the fact that the business has not yet been receiving refunds. These are VAT refunds from ZRA. Now, the risk there is in two folds. The first aspect is the fact that there is no liquidity coming through. The second aspect is the fact that because these amounts are kwacha based, the rapid depreciation of the kwacha implies that this amount significantly reduces. And what you will see in the 2020 financial results, you'll see high levels of exchange losses relative to prior years. I think that would be one other aspect worth noting. The positive aspects, I think we've already spoken to the KCM load shift, which has a direct impact on reducing the impairments as well as improving the cash generation. The one thing that we are sure of as a business is our ability to manage our costs. And in this year, we essentially continued to pursue our automation and cost management initiatives. And what you see is a drastic reduction in cash costs by about 21%. Now, overall, in managing the balance sheet, to ensure that we move the balance sheet from a lazy balance sheet into an active balance sheet, and also try and mitigate some of the risks that have been already alluded to, we managed to prepay 20 million to our lenders, thereby reducing our overall debt portfolio. But lastly, one of the big things that we always strive for is to ensure that we continue to keep our key stakeholder happy. And as a result, we managed at the end of the year to reward our shareholders with a distribution to the tune of $34.1 million. Now, the financial highlights on a glance, I think those are the sort of numbers. Reduced revenue from 408 to 371. That in itself does not tell us much. It is important, but it doesn't tell us much. But I think it's important now to come and look at the profitability matrices, because what you see is that whereas we are supplying KCM, for example, with power, we are now providing a service, which means that both revenue and cost of sales will be impacted. And therefore, in that instance, your margins become more important. The next aspect you see is that our cash conversion, there was an improvement for the reasons already alluded to. Typically, we sort of target between 62 to 64 as our cash conversion ratio. This year, there was a slight improvement to 66 at the back of the drastic reduction in cash costs. I already spoke to the impairments, the level of bad debt impairments, which significantly increased from 55 to $94 million. Now, despite that drastic increase in impairments, we managed to post an EBITDA of $32 million, which is marginally lower than prior year at 36, but it also feeds into a profit after tax of 5.6 million compared to 4.2 the prior year. We've already spoken to the cash and the gearing, as well as the reward to our shareholders in form of dividends, which increased from 1.9 US cents to 2.1 US cents. To put the numbers into context, it's always good to have a trend analysis, because then this allows you, our shareholders, to essentially assess the performance of 2020 relative to where we are coming from. So if you look at the various financial matrices, you see that we've got revenue there, and the trend was going up, and a significant drop in the year 2020 for the reasons that we've already mentioned, which is the shift, load shift for KCM. But you see that that directly does not translate in a reduction in gross profit. And I think this is where looking at different matrices helps to help inform the financial position of the business. We see that there was some sort of increase in gross profit, and what pushes the EBITDA down really is directly linked to the level of impairments that we had, which pushed the EBITDA down from 36 to 32, when the normal sort of EBITDA level for the business is over $100 million, as you will note in the years 2017 and 2018. Again, looking at more trends for the business to assess whether some of these trends are permanent or they're temporal. You'll see that from a cash perspective, we continue to strive to reduce cash costs, because that's the only thing that we believe we have control over. Levels of impairment, as you see, we are coming from a period where we had close to zero impairments to the point when IFRS 9 was introduced. We expect some level of impairment, but definitely not to the tune that we are seeing in the years 2019 and 2020. I've already explained the reasons for the exchange losses, but you see that in prior years, again, we have not had this challenge. But in this year, two aspects: the non-payment of the VAT refund, as well as the depreciation of the kwacha, essentially increases the costs for the business, in that we are now recognizing exchange losses to the tune of $9.6 million. Again, we are a capital-rich business, and as a capital-intensive business, we pride ourselves to use our assets as a means of generating our cash flows, and you see that the trend of depreciation there is in similar range. When we look at our shareholders, we want to continue to reward our shareholders. We want to continue to post some form of return to our shareholders. Now, you see that over the last 5 years, we have significantly grown the dividends from levels of $16 million in 2016, and in the past year we were at 34, which $34 million was a 10% increase from the prior year dividend of 31. Now, we hope that we can continue, despite all the risks that have been alluded to continue to provide our shareholders with a reward. But just to put this into perspective, we generate wealth, and we share this wealth amongst all the stakeholders. So what you see there is that the local suppliers essentially take up about 55% of the wealth that is generated by the business, which goes to state the amount of contribution, or the contribution that the business makes in the local economy. Because once this money goes into the local suppliers, there is a multiplier effect. which is there. We also have, because of our specialized nature of the business that we have to procure certain services from offshore foreign suppliers, and we essentially procure about 17% of the services out of the money that we've generated. Now, what is interesting again to note is that despite the increase in, let's say, shareholder rewards that we've seen on the previous page, we see that the next largest receiver of our wealth is really the government in form of taxes. You see that they've gotten close to 10% of the wealth that we've generated if we look at it over the last 5 years. And then from the government, that's when we get to the shareholders, who essentially got 7%, coming down to employees and then contractors, lenders. And we always strive to try and plow back some of this money through various initiatives with the communities and the areas in which we operate. So in summary, as a business, we are quite happy that having operated, if you look at it on a 5-year basis, we have provided the necessary rewards to the various stakeholders. We continue to contribute to the economy. We continue to contribute to Treasury. We continue to provide decent reward to our shareholders, as well as plowing back to our communities. I'll now hand back the presentation for the MD to conclude. Thank you.
Thank you, Mr. Mkuka. I'll now just speak briefly to the priorities and the priorities for 2021 and the outlook of the business. So what are our priorities as a business for the year 2021? Key to our strategy in 2021, we need to focus on optimizing performance. And what are some of the issues that we need to deal with in this area? So key to the performance of the business going forward is the need to resolve these contractual issues. This is top priority for a business, as I had indicated. So we'll continue to focus on this, and hopefully by the end of the year, we would have resolved most of these issues. The second critical issue under that pillar is the embedment of the cost-saving initiatives. The CFO spoke to the reduction in cash costs that we saw in 2020. So we're continuing with implementation and embedment of those initiatives in the business. And again, important to our strategy is the successful delivery on the capital program to support both asset modernization and the digitalization that should then help in driving efficiencies in our operations. The second critical pillar of our strategy is the strengthening of our supply portfolio and the demand side arrangements. So some of the key issues that we need to deal with there is our investments in distributed renewable sources. We see that as a critical ingredient in our supply portfolio that should help to mitigate price increases, but also help in strengthening the supply portfolio. This obviously is important as we contribute to the wider energy transition agenda that the world has embarked on. We also continue to explore opportunities to offtake power from IPPs. In 2020, we signed 2 relatively small IPPs. That again is something that we are focused on as a business as we ensure that we strengthen our supply portfolio. Again, importantly, we'll focus on actively supporting and participating in shaping the country's future electricity market. There are a number of national tasks that are going on at the moment. One of them being the so-called open access regime. So there is a task there which is supported by KfW, where the country is trying to restructure its electricity market. We need to move as a country to the next stage of the electricity market. So work in that area is critical as the country seeks basically three things. One, to enhance the competitiveness in the market. Second is to open up the whole of the transmission infrastructure in the country. And thirdly is to move to a more sort of open economic pricing regime. So as a company, it's important that we support that process and actively play our role in shaping that process. Thirdly, the critical pillar of whatever we do is obviously relationships. Both the board and management are quite focused on this important pillar. We do need to enhance relationships, whether we're talking about government, the local community, our investors. This is important. There is no way the company can be successful without having a good relationships. That's something that as a company will continue to focus on. In terms of the business outlook, I think I've spoken already to the performance of the red metal, which hit $10,000 per ton just yesterday. So that performance, we believe, is going to spur a productivity by the mining community around the globe, and we hope to see increased demand in that area. In terms of the impairments that have impacted the financial performance of the business in the last 2 years, this, as a company, we believe we've come off the worst years, and from this year going forward, we shouldn't see those significant levels of impairments. We'll see some levels of impairments, but we think those will be quite minimal. I've spoken to the customer demand and indeed the COVID-19. More importantly, on COVID-19, we've seen the rollout of vaccines, and I think this is obviously giving everybody confidence that things should begin to return to normal. And if that happens, then we should expect a much better business environment going forward. In terms of just providing some guidance to you as our shareholders, our investors, I've just spoken to the COVID-19 situation. And as I said, the rollout of vaccines should improve the environment. And we do think as the environment improves, this will facilitate speed and efficient implementation of our capital program, allowing continued realization of operational improvements and indeed service quality to our customers. The second one is the impairments that, again, I spoke to. We do believe with a reduced level of impairments, we should expect much improved profitability of the business from this year going forward. Overall, we think as a company, we are achieving a very strong balance sheet, and this is important in supporting our augmentation of the supply portfolio that we intend to achieve. But more importantly, this is important in supporting long-term growth and indeed dividend distributions. So in summary, what do we want you to take away from today's discussion? We think as a business, we've managed very well the impacts of the COVID-19 situation. We focused on the safety and health of employees and contractors. We continue to maintain high security and reliability of the power network. We are alive to the need to support both the government and our local communities. That's something that we'll continue to do as a business. However, we want you to note that despite all these challenges, the company delivered a very strong underlying financial performance, and we do think this can only get better going forward. And more importantly, the company has achieved a very strong balance sheet to support growth and dividends going forward. Thank you.